Hi guys, it's my pleasure to have you guys here and to introduce this amazing panel. We're going to be talking about tokenizing assets in global capitals market. And we have an amazing panel of experts from various different fields that will talk about what we need to do moving forward post the ICO craze of the last 2 years. Here is John Pygott. He's the CEO of Abe Global. He was the CEO and founder of BondPoint, which did fixed income security exchange, which was later acquired. John practiced securities law in DC, and most recently has advised many exchanges globally. We also have Era. Era Agnosti is partners at the Global Capital Markets practice of White & Case, which is a top-tier law firm. And she has reviewed extensively the ICO market and STOs and has experience with the SEC. We also have Paul Atkins, who is the CEO of Patomark Global, co-chair of the Token Alliance, appointed by President George W. Bush to be the Commissioner of Security Exchanges and Commissions in 2002. And Commissioner Atkins' career has focused on financial service industry and security regulation. Before he was appointed as the Commissioner, he assisted financial service firms in improving their compliance with the SEC regulations and worked with law enforcement agencies to investigate and rectify situations where investors had been harmed. We also have Joe Bloom, who is the COO of Abe Global. He was also the founding COO of Thinkorswim, which was acquired by TD Ameritrade. And he is also the founder and board member of PBF Solutions, which was acquired in 2017 by Raisin, which is a European FinTech 50 company. Who had fun in the ICO market over the last couple of years? It's been pretty crazy. We've seen it all over the board, and now that the bottom has fallen out, where do we move going forward? So I want to talk about what allowed the ICO market to be created, and what were all of the financial fraud that happened there, and are there any gaps in the legacy system that allowed the ICO market to be created? John, do you want to start with that one?
Okay. Hi, everyone.
Sorry,
for starters, what we think created a lot of the energy behind the ICO craze is the shutting down, frankly, of small capital formation in the US and a lot of the OECD countries. For the 60s, 70s, 80s, and 90s, we would IPO 300 to 600 small cap IPOs a year in the United States. In the early aughts, 2002 to 2006, we instituted some policies that improved part of the markets, but one of the consequences of them was that it really just devastated small cap capital formation. When we say small cap, we mean companies $200 million to $1 billion. So the small cap IPOs, after the result of these regs, dropped off by 90%. They've never recovered. So we think that we had a lot of this latent energy out there for story stocks, for participating in it, and a new generation of investors that are much more global in scope and they don't feel constrained about doing business with people who they met on YouTube or Instagram and accord them the same credibility as brokerage firms, which is very, very different. But we do think it's moved to much more globalization. And a lot of these high energy stocks, the movement, the investing of that has moved into the ICO sector.
Interestingly enough, this was really a retail market. And when we talk later about it, we're going to talk about what that means and where we go from here. But as a guy who spent a fair amount of time amongst traders in Chicago, where we are inherently contrarian, it gives me kind of a great delight to look and say, you know, everything that people have said about investing for millennials was wrong. That in fact, you know, they're not just going to sit back and put money in their various ETFs and indexing, but rather they're really interested in stuff that has a story, in stuff that has the potential to really do things, they're interested in transparency in the marketplace. And so I believe that the character, the retail side of this market is really led by people who will lead the next market as well from a retail side.
Paul, Do you think it was just all financial fraud, or was there something else there in the ICO market?
Slides, if you
Oh, and you have slides.
Oh, how about that? That's right. Well, yeah. Well, thanks. Well, so I guess we've seen a lot over the last year and a half or 2 years with respect to the ICO market. I agree that as far as the hunger for people to raise capital or whatnot in a less costly environment, we've seen that pressures, particularly after Sarbanes-Oxley was enacted back in 2002. The costs to become a public company have really risen a lot, and we've seen a lot of testimony as to the effect of that on the capital markets. And like John said, the number of IPOs hit a high water mark back in about 1996 with almost 800 a year. And then here over the last few years, with a few upticks after the Jobs Act and whatnot, it's been in the hundreds, 100-ish. Per year of IPOs, so that's been a huge effect. But with change in technology, and obviously with blockchain and the introduction of that, and with crowdfunding, for example, we see a lot of hunger to disintermediate and disrupt the brokerage industry, and they have their standard for IPOs 7% that they've been able to maintain in the traditional marketplace. But with respect to companies wanting to raise money, we're seeing that that hunger to try to get capital in different ways. The private markets have really grown also exponentially since 1990 through 144A, and just the private equity and venture capital markets having a lot of capital sloshing around, so that you have companies able to bypass completely that early stage. And that brings me to a slide. So this is a great slide by Andreessen Horowitz, to give them full credit. But anyway, you can see on the left-hand side, if Apple, Microsoft, Oracle, Amazon, the dark part up top, that's the public value creation after an IPO, the amount of value that people investing in the public company have realized with the growth of the company. The red underneath is insiders, the ones who invested in early stage. And so you can see Apple is a little bit of an anomaly, but it was an interesting company when it went public back in 1980. But you can see how these companies went public in the public markets to raise capital to build their company. And then look on the right-hand side, you can barely see the public value creation, and most of the value through going public accrued to the early stage and insiders. So that itself tells you that the current marketplace has morphed from a capital raising type of perspective to basically a liquidity event to help cash out the early stage investors. You need that in order to attract private equity, venture capital. You have to have liquidity events in some way, sometime, but it just shows you how the marketplace itself has changed. So anyway, so that I think sets the stage at least for the opportunity in the future, notwithstanding that some of the early ICOs, I hate that term anyway because it's a deliberate play, obviously, with initial public offering. I think it got the whole marketplace off on the wrong foot with respect to the SEC and everything else.
Wonderful.
If I could add just 2 quick footnotes to Paul. The consequence of that is 97% of the people who are non-accredited investors in the United States have been excluded from the greatest wealth creation engine that the world's ever seen. All right, post-World War II, growth capital investing in the United States was incredibly powerful at distributing wealth more evenly, creating a middle class. And what you're seeing on that chart is the withdrawal by the capital markets from 97%. And Paul, remind me, there was one SEC commissioner that voted against these reforms, Reagan and Mass. I can't. It was Paul Atkins,
2 of us,
actually. And
right.
He's too graceful to say he told you so, but let me just say it. He told you so, he told you so, he told you so. But
Era?
Era, you've reviewed a lot of these ICOs. Is there things about them that you like, or what are the lessons that you've learned looking through these?
It's certainly so. I was one of the core group of people at the SEC that, was tasked with reviewing practically all the token offers that were filed with the commission, and as a way of also concentrating all like the knowledge building and, like the thinking and the common process within one group. So I was, I guess, fortunate enough to manage the reviews of all of these filings, because you also saw certain trends, and there was a way of like learning and identifying issues and then figuring out how to solve them. And it was really interesting because we did a lot of engagement also with the community. There was a way of sort of like really trying to learn through talking to the developers and talking to the companies. What is the token? How it's being issued. I mean, I think that the blockchain technology has already been transformational in a way that the last 10 years I was at the SEC, I never dusted off, like the Howey test and ran, like what is a security, because there was no need. So now we're doing that. So as part of the review process, we had to really rethink everything about an offering. What is it, the security? How are the rights, being, granted to the security holders? How is it being sold? How's it getting paid? And then, like what that security is going to look in the balance sheet, and as well as, what are the law firms, what type of legal opinions are the law firm issuing? So I do think that the market has self-corrected itself to a certain extent. We don't see the sort of, the wave of the native token offerings. I'll call it a native token offerings as opposed to an ICO. And the discussion about, security token offerings. So we, prior to leaving the SEC, in last October, you saw more of these filings that are coming through as, like common stock wrapped, with the token, the smart contract around it.
Okay, wonderful. Paul, you got to oversee one of the largest Ponzi schemes. I've often heard ICOs referred to as Ponzi schemes. Do you have any thoughts on that? Any lessons learned from this market and what we can roll into regulation in the future?
Well, I'll not cast aspersions on every one of these token offerings, but clearly some were better than others. Some were kind of blank check offerings where the company really had no kind of plan or anything. It was just going out there to sell a token and on a dream and a prayer, basically, which is kind of what the securities laws were designed to prevent, but basically with a promise that, don't worry, look at Bitcoin, how that's gone up, and you'll replicate that with your investment with us. Others that I know of are real businesses and have a real product and they have real customers and all of that. Some of the things they lack, of course, are audited financial statements, which that's kind of a problem with the securities laws and going public. But whatever, hopefully we'll be able to work around some of that. So I think that sort of thing is in the future when we see offerings, I'm hoping with some special creativity from the SEC that maybe that this whole area will become a real robust type of thing. And one thing that the market lacked, and I have a second slide for you here, was with respect to liquidity of the marketplace and pricing and transparency. For the longest time, of course, with respect to Bitcoin, it was only what you see on the trading platforms, and there was really no way to short it or anything to kind of dampen the feverish bubble that was building until, and I give credit to Chris Giancarlo and his leadership at the CFTC, but when the CBOE and the CME came out with futures on Bitcoin on the 17th, both were up and running by the 17th of December 2017. And so guess what happened immediately after that? The price of Bitcoin became, one would argue, more realistic. And so you can see its peak price was on the 17th of December 2017. With those futures contracts, it was then possible to short it, and institutions got involved. And so Bitcoin then found a level, and then other things have buffeted it, but that's with any commodity, what's to be expected. So anyway, so I think things like this really do help institutionalize and make normal a marketplace, and so I think that'll have good effect in the future on future token offerings.
So one point to make there that, like I think that, ultimately a mass adoption of whether it's the blockchain or the digital, capital raise is the technology is not quite there for some of the players. So obviously a lot of the companies that wanted to capitalize on the craze of the ICOs were, really early stage. They really had no proof of concept. They really didn't have also the means of how to really program the smart contract in order to have all your, governance provisions in it, or, like how to vote it, or like how somebody a token holder can initiate a transaction. So the interesting part is part of the comment process. Then you start to sort of unpeel the onion. They understand that they all had all the intention of putting still all those rights in a written contract. So you're like, then it's like, oh, okay, so you don't have yet the capability. So I think that once that the technology really gets to the point that the smart contract will be really this robust document, and the investor, particularly the retail investor, that has such an easy access now to this form of, like investments, have a way of, like reading it or understanding it. I think that's where we're going to see more of these, digital token offerings really taking place.
Nice. Joel, what were some of the lessons that you learned from the ICO market?
Well, I think about it again as a trader, and I have to say that a lot of the market psychology, or excuse me, the personal psychology was wrong here, in the sense that there's a reason that early stage is generally logically a private capital market point of view or a place, because you need long-term capital involved there. You don't need to be involved in starting it, and then all of a sudden trying to have announcements so people will trade it, so it goes up. And what you really need there, you don't want. We've learned in the past, you don't give people a big pile of money on a promise and then not watch them and make sure that there are consequences to not doing what you say. And to me, there's a logical point at which you need a private and public sort of partnership, so we get to the things that we talked about here and give everybody the opportunity to create wealth as an investor. But that's not the point that you need it, because you need directors really involved at that early stage who understand your business and are there to see it succeed, but who also have a lot of skin in the game, who will guide people and make sure that those consequences happen if people fail to do what they're supposed to do.
John, if security tokens are just sort of like a common stock, then why did the market fall out? Why did the whole thing look like it just collapsed?
Well, what we've learned is that, we always wondered, those of us who've been in the business of building marketplaces for 20 years or so, we sit around sometimes at these conferences and think, like, are we really doing any good, by having trust companies and brokerages and licensed exchanges and market makers and all this regulatory and technology and capital market infrastructure? And to me, one of the interesting parts of the ICO episode is to see what capital raising and trading looks like kind of in a feral, native, unregulated environment. And it looks, frankly, like what we would have expected to, which is a big pump and then a sharp decay curve to where it just slams down and people just get obliterated in the secondary market. So from our end, I think one of our lessons is we love the idea that it's global and that it brought people in individually, as individual investors into capital creation at early stages of companies. But the structures that we've had in traditional legacy capital markets were actually there for a reason, it turns out. You need institutional investors, you need long-termers, you need regulators, you need brokerage accounts looking out on issues of suitability and accountability and KYC. So the task, I think, now for us all as an industry is to kind of combine the best, is to take the energy of the tokenized world and bring it into alignment with the compliant capital world and try to meet somewhere in the middle.
Wonderful. Ari, this is kind of an odd question, but I always think people try to make the best decision they can with what they have. And so we saw during the ICO market that both companies wanted to raise capital, so they would perform an ICO, and then on the other side, people bought these. So if people are making the best decision they can, why did people choose an ICO over like a Vanguard? Why would a retail customer want that? And what can we learn from that?
So I think that, like a lot of people, bought in the sort of, like the growth in value like the Bitcoin had. I don't think a lot, particularly on the retail investor side, there was this understanding of, oh, this particular token is going to have this type of functionality within a particular ecosystem, and that's why I'm buying it. I think that the general census is, I'm going to buy it, and there is a secondary trading market, and I'm going to start trading on it, and then I'm going to become rich out of that. So that's why I think it had such a rapid rise. And it was, again, I think accessibility was key. That's why from, like the regulator's perspective, because of this, like great access to the ability to invest, you have to also have, like the ability to know and understand and have enough disclosure around that particular investment.
Well, and also, like with any bubble, you always have people thinking, "Oh my gosh, I need to get in on this as soon as I can." The secretary of a colleague of mine asked him, should we invest? My husband and I invest in Bitcoin or Ether or whatever it was that she was asking about. And she said, my husband's just returned from Iraq from being deployed there, and he's come back to his base, and he sees everybody being a millionaire because they put their money into this, and so we're wondering if we should do it. So of course he said, no, let me talk to him, and so he talked some sense into him. Obviously, I mean, it's one thing to take obviously an educated speculative risk if you want to take that, but to go in it with your eyes open. But so that's one part of it, obviously. But on the other side too, on the issuer side, those companies that came out with the ones who are not just complete scams, but the ones that are legitimate companies that have a business plan and we're doing it. Unfortunately, I think there were among the gatekeepers, as the SEC likes to say, meaning lawyers and other people who advise companies. There was a lot of happy talk about they wanted to be cool and we're really with this new technological movement here. And so I think they told people a lot of what they wanted to hear. And so with a few incantations sprinkled in your white paper or whatever, you can immunize yourself from the securities laws, which obviously people found is not the case. But still, I think on a lot of these, and I know some, famously are pushing back now on SEC enforcement actions. And so I think, there's a lot of merit, at least to some of the arguments that I've seen. And so we'll see where that comes out and what our former colleagues back at 100F Street will do with some of these things. But still, I think it's, I think there is a huge amount of room for legitimate people to go out and whether they sell commodity tokens, security tokens, or like we did with the Token Alliance, we came out with our white paper last summer to talk about utility tokens. And yes, Virginia, there does exist, utility token concept, and so I think we'll see more and more of that be developed as people get smart and come up with their business plans.
And I think that the SEC, has started to embrace this idea that that could potentially be a utility token. In these engagements through FinHub, which I think was a great development that happened, like last October, is they have seen the path when there is a proof of concept and the capital raising is kept completely separate from the token as a utility. They have come, as I understand, in certain determinations on a case-by-case basis that companies may actually have a utility token as opposed to a security token.
That kind of leads to my next question, is there a real-world advantage to tokenizing a financial asset?
Well, there's a lot of talk out there about, like tokenizing, assets that, were illiquid in a way of creating, like markets and secondary trading. I hear a lot about real estate. I hear a lot about, works of art. I'm not sure what the demand is there, if there is a demand yet, because a lot of the issuers come and ask questions about, tokenizing, like a fund. I yet have to see anything successful done in that space. Obviously, the Company Act has a lot of restrictions that you have to be complying with, but I do think that tokenizing like just straight up securities and common stock is a way of getting more transparency, having, easier, corporate governance, like maintaining your books and records. I absolutely think that, to the extent that there's a little bit of more standardization on what is the security token going to look like, and there is definitely discussions out there of standardizing what a security token is compared to, the ERC20 Ethereum. I think that there's absolutely great, appetite for that, and then I can see it going in that direction because, again, technological advancements are happening every day. From like companies figuring out ways to comply with AML and KYC to now perhaps creating this standard token security.
Okay. Joel, I wanted to ask you the same question, but from the trader's point of view. Do you see as a trader having advantage in a self-clearing and settling system for tokenized assets?
Yes. So, well, to follow on Era's point first, I can see all kinds of potential advantages for companies, even once we create the rails, to have not just the security token, but then tokens associated with that, whereby companies can reward investors, or at least there's all kinds of, could create their own ecosystems and with the people who have the most interest, who are the investors. And so following on to that, and then you referred to really what's the infrastructure space or the underside of the world, which is, I believe we can create new rails and really change the whole life cycle of the asset by tokenizing it and create a whole new way to change the way we trade them in the infrastructure, to the way we settle and clear them. I expect to see us go to eliminating all these omnibus accounts and brokerages where the issuer will actually know who owns the shares for the first time ever and can actually communicate with them. And just giving that capability out in the marketplace will be new, and people will find all kinds of great ways to use that, to be able to directly communicate with their owners. And you take that on then what you can do is kind of the unseen plumbing of our systems, where we take down risk by clearing and settling immediately and eliminate all that risk that sits out there with T+1, T+2, T+3, where the money is floating around the system before it finally gets together and you finally see if you actually have a trade, right? And you combine all of this together and all the things that I can't think of, but if we give great capabilities to people who can create new ways to use this functionality, who are way smarter than me about it, it's going to be very interesting.
Yeah.
Paul, you look like you have some thoughts on that.
Oh yeah, no, I agree. I think the use cases, we can dream them up, and we'll see how the market develops it and drives it forward. And so certainly, on the clearance and settlement side, that's one potential huge potential there. The one thing, in blockchain itself being a new technology, and a lot of people will be experimenting with it and improving on the concept. The one challenge we have, of course, for real distributed ledger is to incentivize people in a non-security type of token context. How do you validate the transactions, and why is it in someone's interest to do it? So that's the challenge. If you have non-distributed ledger things, it's sort of the homegrown type of token systems, that of course obviates a lot of that. So anyway, so we'll see, I think, how people dream up a better mousetrap, but I think that's in the next 5 or 10 years would be very interesting to see.
Okay. John, I have this question for you. Could we bring back, because it sounds like there's certain aspects of this technology that are really useful for the world. Is there a way that we could bring back a global market for tokens safely? And what would we need to do to accomplish that?
Well, first of all, I think there is, or else we wouldn't be here. Well, I certainly wouldn't be here if had other things going on. Law and Order reruns to see, type of thing. So clearly, we're long-term believers in the technology. I got involved with Bitcoin in 2009, end of 2009, and avoided the ICO stage, but have always been long-term committed to the technology. I do think, to Paul's point, this is the year when we need to start delivering, as an industry group, we need to start delivering specific use cases that are very kind of narrowly defined and kind of really capture, that we can get people to pay for and demonstrate clear economic value add and creation. And that gets down to whether, like Era was referring to, these multiple incentive systems alignments, where you have a company where you have points rewarded for frequent use, for other customer referral, for user-generated content, and combining that with a tokenization where you have, that is also the investment instrument underneath the company. There's a lot of opportunity for creativity there. The asset-backed securitization field is one where we think, as an institutional set of institutional markets, is very open for dramatic improvement. The information flow is notoriously terrible there. Mortgage bond market, about a $30 trillion market. Traders usually find out 5 to 7 weeks later what the value of their trade was when they originally made it. Tokenization of some of those structures can quicken that up. As Joel was referring to, the switch from this system we have now, where when Tiana sells a bond to Era, the title goes to her bond broker, sometimes a central clearing party, Era's bond broker, and finally to Era's account. And to protect the market meltdown on that, the regulators require that each of these intermediaries keep a capital balance, just as a giant shock absorber in case something goes wrong. One of the big reactions to the 2008 crisis for US regulators was to increase the capital reserve in the system, the size of these shock absorbers, from about 220 billion to 2.74 trillion now. And so if we're able to use tokenization, which we absolutely should be able to do in the next 3 or 4 years, to have a delivery versus payment so that you don't necessarily mediate anybody on the service side, but when a transaction moves from an institutional seller to an institutional buyer, it goes directly between their accounts. You do two things. First of all, two things. I hold up three. I was never strong in math. I was told there would be no math on this today.
Yeah.
Two things. One is you take $2.5 trillion that's sitting dead on bank balance sheets and you put it back into the productive economy. And secondly, you reduce of the risk of damage from a market panic, which they're inevitable, they happen. But we can reduce the risk of that by, we think, more than half. So you end up with a safer and more stable market, a lot more capital put out into productive uses instead of sitting to be these shock absorbers that we no longer need because it's time to move on from a 19th century capital reserve system in trading. So when it gets down to like really specific use cases there, we as an industry think we need to demonstrate that to the capital markets that this token technology can deliver on very specific value creation points.
I think that you might be a good time to start talking about the project that you and Joel have been collaborating on around, I think from the economic point of view, we're talking about how do we, what the ICO market taught us was that there's investors that are hungry to build companies, and there's people that also want to invest in it. And there's also a market for 24-hour global trading. And the other thing that we saw was that a company could go raise $100 million even if it was on a prayer and a song or something of that nature, just mind-blowing. And they could do that outside of the United States, which I don't think had been done before, which really is opened up a world of opportunities economically and globally for globalization. So I wanted to see if you guys would talk a little bit about your guys' project, Abe. And I think I had a couple slides on that for you guys.
Great, great. If you insist.
If you insist.
All that stuff that I just said that the industry should do, we don't want to, that looks like real work. We don't want to do any of that. What we do want to do is to solve the challenge of crypto as an asset class. If you put everything together, is $120 billion, all right? That's a lot of money if it's yours or mine. But in terms of global capital markets, that's not even that's about 1/10 of what it takes to be an asset class. There's over 175 trillion of capital, US dollars, in under management in OECD countries alone. So what our project, Abe voted on, what our project is focused on, yeah, that's kind of it, is really kind of connecting those 2 points up, the tokenization market to the compliant capital market. And I know that this offends kind of some of the purists and the tribalists in the token world that want to live without government and live without money and all, and that's, good for you. Good, I'm rooting for you. Meanwhile, we've got a lot of value that we can bring using this technology to the compliant capital markets For individual investors, we can reconnect, disintermediate, and reconnect individual investors with opportunities around the world. So what we're trying to do here is to create that bridge between the world of tokens and the world of compliant capital markets, right? So to do that, we have securities exchange, not crypto exchanges. We have securities exchange licenses pending in 5 countries, the EU, the United States, Tokyo, Singapore, Hong Kong. Tier 1 securities exchange licenses, all sharing a common infrastructure to take advantage of 3 of the things really that we like most about the ICO markets. Number 1, it's global. Second, and global nonstop, 24-hour trading. Secondly, that it's extremely low cost to connect up opportunities and individual investors. And third, that allows the flexibility that our current technology doesn't use. Now the question is, how do we do that within a compliant footprint so that we all look bad in orange, right? Maybe Joel looks good in orange, but it washes me out, right? So to do that, what we've got is a scenario. We've got these 5 exchanges in process. The first license will be granted probably next quarter, and we'll roll these out towards the end of this calendar year, so that by the end of this year, we'll be able to list a token qualified as a financial instrument under ESMA directives in the EU and as a security, how we test security here, list that on our key exchange in the EU, have that wrapped in a depository receipt, and that depository receipt, an ADR here, GDR elsewhere, is what we can move right now through the compliant global capital system, both in terms of the financial technology and the compliant structures. So with no changes to technology, with no changes to compliance, we can take a blockchain, a tokenized asset, wrap it in a depository receipt, and move it through a global 24/7 capital market. And that's kind of the bottom line on it. We've been in stealth mode for a couple of years. We're really just coming out of it as of this morning. So it's a fresh look that you're all getting for the first time. And we're building, it's going to be a one-stop, compliance in one country, one language, all English language. We'll be able to take down the cost of listing a security from average $4 to $6 million now to more in the range of $300,000 to $500,000. Trading will be trading costs we can bring down by at least 80 to 90%. Joel's background is bringing direct access to the U.S. equity options market to retail investors. He was a co-founder of Thinkorswim, which is the largest options platform in the U.S. My background was founder of BondPoint, which we brought direct market access to individual investors to the U.S. bond market. And this is the newest asset class. We want to bring direct market access in a compliant way through existing brokerage structures to the entire asset base of crypto.
And that leaves us about 6 minutes, unless you guys had any comments.
Got a couple songs?
No
anybody?
songs.
No, so
I didn't want to break his concentration there, so I just let him go ahead.
Please.
No, go ahead.
Did you guys have any questions for the panel? Wonderful. Yes.
In your discussion of the ICO market, sometimes people talk about it, and it's as if grandmothers are cashing in 401ks and bringing cash to the market. My mental impression is that's not the case. That a lot of the investment is from other coin, and maybe it's people who are trying to diversify across the asset class. Can you comment on that? Do we need protection in that area? Is that what's happening? What percent is actually dollars going in versus other coin?
Well, I can talk a little bit towards that. So it's like if initially there was really only one on-ramp into this space, which was through Bitcoin. So you'd take a fiat currency like a dollar, a euro, something of that nature. You'd buy Bitcoin, and then you would buy Ethereum, and then you'd buy whatever ERC20 token that you wanted to. So you'd see it sort of like jump across several different just to get to that. And then as the ICO tokens would go up, people would try to diversify across the other ICO tokens or back into Bitcoin or Ethereum or some kind of something like Tether. Yeah. Does that answer your question around?
The audience
Yep.
also. So your hypothesis is 100% started in dollars and bought Bitcoin and moved to something else.
No, you also have other mechanisms of getting
Fiat.
Bitcoin. So you could have mined it. So you would have had miners that would have bought capital equipment and bought electricity, so that would have been paid for in some form of fiat, and then, unless they were a nation state, and then they would have bought the tokens with that. But typically, they're pulling it back into fiat.
But to your point, I think your point is, I think it's right. Net, it did not do anywhere near as much damage as it looks like when you look at, well, it went from 20,000 to 3,000, or the ICOs blew up, or whatever. If you think of Enron as a quantitative unit of financial fraud, we're talking about 2 or 3 Enrons, right? Net altogether. NIP, which is, I think, is a lot of the reasons the regulators felt comfortable stepping back and letting it kind of evolve and build out on its own, is it had capacity for great damage, but it didn't actually do the type of financial devastation that a lot of market bubbles bursting usually do, where the mortgage bond market or the real estate market in 2008, or the asset bubbles from the internet stocks in 99, 2000, 2001. That said, there's no reason to let it continue out if we know that, we've got an investment product market that's creating, and for the first time can live in a digital universe completely outside of any databases. And so I think the regulators were fairly responsible in letting it grow out and play out for a while, but then bringing some constraints on it now.
Well, and I guess, in some ways it might be a little early to tell too. So far we haven't heard of any, terrible people losing their houses and all of that, I think, to John's point. So, and hopefully that's not the case, and hopefully people have been, judicious in how they've put their money into this market. I do worry about that, like that story I told about, folks in the military dumping their retirement savings and whatnot into this marketplace. So you don't want that to happen, but maybe they did it at a very low basis there with Bitcoin, and they're still riding high. You never know. And so I think it's just we haven't heard the doom and gloom that a lot of people were predicting. So that's great. But at this point, of course, the field has changed, and the SEC is very, let's just say, actively involved in this area. But I'm hoping for some direction coming from them that will help adapt to this space.
I think we have time for one more, and then our time's up. Yes?
Do you think Bitcoin will go back up as it's predicted to do?
Oh, me personally?
I guarantee, no.
The magic 8 ball.
They always like the halvings. It's like a mythical story. The halvings is sort of like the prediction for when you have this sort of like this rate that the new Bitcoins are generated, and then when that rate drops, sometimes the price spikes. But of course, it's a very speculative market. I think Adam Smith would be very, very happy with it, because it's this very pure market that's just pure. There's no underpinning in it. So who knows? It could go up, it could go down, and either way, you're right. So, yeah.
But blockchain is here to stay.
That's right.
Period. It's one of those technologies. If you eradicate all blockchain technology on Earth today, the fact that we now know that this is possible is an inflection point that we don't cross back over. So now that we know that we can build distributed systems that can confirm and essentially have a self-authenticating data packet, that is a completely new universe, particularly in terms of capital markets and capital market technology. At least half of what we do in banking and brokerage is check databases, all right? So the simple fact that we can create data packets and exchange them around and move them around securely without having to hit 50 databases, we'll never go back.
Thank you guys for your time.
Thank you.